Welcome back. Well, we just learned that the Federal Reserve, led by Federal Reserve Chairman Powell, is steadfast on fighting inflation, and they will continue to raise interest rates over time to fight inflation. Well, the Chicago Fed famously said, "Our two goals of price stability and maximum sustainable employment are known collectively as the dual mandate." You see, the Federal Reserve, the job is to create an environment where we have stable prices, meaning not too much inflation, and also not to destroy the jobs market. So I thought it might be helpful. Take a look at the charts and to see where we are. This is present day. The black histogram bars represent the federal funds, the interest rates, currently at the 525, 550 level. The white line represents CPI, which is Consumer Price Index, the popular measure of inflation. The red line is non-farm payroll. And both of these are measured on a year-over-year basis. So this July to last July, just to make an apples to apples kind of comparison. The yellow line is the inflation target of 2%. Now, the goal here is that the Federal Reserve wants this white line to be as close as possible to the yellow line. They want the inflation number to be at the target of 2%. It can be a little bit above and a little bit below. The challenge is they can't just raise interest rates forever or through the roof because then they'll destroy the jobs market. Too high of interest rates will make it impossible to borrow. Companies can't invest. Nobody can buy a house. So this red line cannot go down too much. And that is the challenge that they're facing right now, is that how do we raise interest rates? And this is the order of things, by the way. First thing that happens is the white line goes up. Well, first thing that happens actually is we have very, very low interest rates, like 2021. Now, remember in 2021, it was post-COVID crisis, and we had a lot of stimulus that was pumped into the market as well. And we had a very, very rapid acceleration of interest rates. But the inflation started back in 21. We were already above the 2% level. Well, that's not actually fair because this is inflation on a year-over-year basis. So it's comparing August of 2021 to August of 2020. In August of 2020, we were still very much in the doldrums of what happened. So that's, not a very fair comparison, but nevertheless, inflation was on the rise. So low interest rates, which created all this inflation. The Federal Reserve says, "Oh, we're well above our 2% target. Let's start raising rates. Raise rates, raise rates." As we're raising rates, I know we're kind of turning over here, but we're still well above 2%. We got to get back down to this yellow line. Meanwhile, we have to be careful. Don't raise them too fast. You're going to crush the jobs market, the red line, non-farm payroll year over year. That's where we are now. The red line is trending lower. The white line is trending lower. The white line, the consumer price index is, a little over 3%. It's still above the 2% target. We just learned that the Federal Reserve is steadfast. They're not changing the 2% target. They're going to continue to raise interest rates until CPI gets down. But let's look back in time. They're trying to manage what this is called a soft landing. They don't want to crash the economy to get inflation down. They want to bring inflation down on a timely basis, but not so aggressively that they hurt the jobs markets. Well, this is what the soft landing looked like in 2016 through 2020. These are federal funds rates down at 0.5%. This is obviously following the years of very low interest rates following the financial crisis of 2008. Next thing you know, we have inflation, the white line that exceeds the 2% target, 2.5, almost 3%. Job market, well, it's chugging along. It's not going up or down. It looks like it's stable. I don't think it matters so much at this point, at least, where the non-farm payroll year over year. It's not crashing. It's not going down. Okay. Well, the Federal Reserve starts raising interest rates. We're at 0.5%, 1%, 1.5% as we go up. They continue to raise rates, and we see now the CPI crosses back below. And they continue to raise rates even after the CPI crosses below. Now, I don't know. I mean, we could look back at Federal Reserve statements why they chose to keep rates that high that long. Maybe it's because the red line, the non-farm payroll, really didn't collapse. They said, "Hey, the jobs market, it's a little weak, but it's not awful." Then they stopped raising interest rates right over here. And that's we see maybe they decide to keep interest rates unchanged because then we really saw some weakness in the non-farm payroll. And inflation was below 2%. They did their job. Well done. Now we see, well, now inflation is really below 2%, and the jobs market, we're only at 1% year over year growth. That's not so good. Let's start to cut interest rates. This is all before the COVID crisis. That didn't occur until March of 2020. So we didn't know anything about COVID at this point. But the Federal Reserve is already cutting interest rates. They saw things were just a little bit, they slowed a little bit too much. So let's step on the gas a little bit. So, and this by far, I think looks like a very manageable, this really was a managed soft landing. Not always the case, though. This is 2003 through 2008. We had a very strong stock market coming out of the tech bubble crash of '01. 2003, 2004, we had 1% interest rates. The jobs market was flat. Now it's up 1% year over year, 2%, almost 2% year over year. Inflation rears its ugly head. The white line goes above 2% target. They start to raise interest rates around July of '04. Raising interest rates. Now, remember, we've raised historic interest rates in only about a year or so. Take a look at how long it took the Federal Reserve to get us from 1% to 5%. 2 years, 2.5 years. This is a slow rise in interest rates. A slow rise in interest rates, which at least didn't really seem like it contained inflation very well. It didn't skyrocket. Maybe in retrospect, maybe they could have raised rates even a little faster, maybe. After all, the jobs market was still kind of chugging higher. We had a very strong economy at this point because we were raising interest rates and inflation kept on rising and the jobs market was still increasing. Well, then we get to 2006 July. They said, let's slow down. All of a sudden, the jobs market starts to soften around the same time the inflation numbers really start to soften. Now, the stock market, remember, did not crash until third quarter, October, November of 2008? That's down here. That's the stock market crash when inflation plummeted. We didn't know about a stock market crash back here in 2006. Very curious, though. Take a look at the jobs numbers. Really fell apart. They really started to decline. We had a negative jobs number, negative year over year jobs a year about before the stock market crash. This is a pattern that we've seen before also, when the jobs market falls before inflation does. Maybe I was wrong. Maybe they raised rates too long or they kept them up too high. Maybe they should have cut them. This is not a soft landing. 2008, for those of you that remember, there was no soft landing in 2008. Let's go back in time further. 1997 through 2003, well, we had this tech bubble, this amazing tech bubble. We had a steady 5% Federal Reserve, federal funds rate. They actually, in late 1998, early 1999, they actually lowered interest rates, if you can imagine that. Jobs, well, that was flat. Inflation, a little bit below 2%. That's why they they lowered interest rates. We were below the 2% level. Well, that worked. And then all of a sudden the tech bubble came to be. And inflation went up and they started raising rates. And inflation went up more and they raised rates more. And they brought us up to 6.5% Federal Reserve funds. Remember the prior chart? The jobs market started to decline May of 2000. Stock market didn't crash until, 2001, we know. The jobs market fell apart first. Inflation stayed pat until 2001, and then all of a sudden it started cutting interest rates. Obviously, tragedies of 2001. And then all of a sudden everything went down. By the way, notice there's a channel. There's a channel between the red line and the white line, that inflation and jobs are going in the same direction. Almost looks like we're driving down the street over here. We want to make note of the width, that it's not increasing or decreasing. Well, at this point, inflation really went up to the upside. We want to see an economy, I think, is my opinion, that where we have a steady, consistent gap between inflation and jobs. We don't want to see a situation where the jobs fall apart while inflation stays pat. But I think that's a natural phenomenon because after all, when the economy goes sour, we lose our jobs and we stop buying. Or maybe we don't get a bonus and we don't buy a new car. And then later on, that affects inflation rates. Inflation's a little bit more of a delayed indicator, I think. Well, let's go back further in time. 1982 through 1993. Remember the inflation in the 1980s. We had what? 10, 11% interest rates. The white line, 5% inflation. The jobs market was very strong in the early 80s. And then we came down 1986, and then of course that famous 1987 stock market crash. But prior to that 87 crash, we had the Federal Reserve cut interest rates. They were cutting down to 6%. Imagine they're cutting down to 6% interest rates. And that's what brought the jobs market down. Well, the jobs market, I think, came down as a result of inflation, but then eventually we had the inflation number below the 2%. Now, we did not have the same 2% policy necessarily. I believe the actual law, the rule of a 2% target was not enacted until Ben Bernanke, I think 2012. You can look it up on your own to verify. It's around that time we actually had the written rule for a 2% target. I don't know what the policy exactly was, but it's always been 2, 3% is basically where we want the economy to be inflation wise. Well, low interest rates did well for the economy. 1987 comes about, and then we start to see lots of inflation again. And the Federal Reserve raises rates again. Notice what happens. This gap widens. The jobs market falls apart in the late 80s, coming into that 1990s tiny little, not tiny, but relatively small recession we saw in 1990. Small in comparison to the others. And then inflation comes down. And the Federal Reserve cut rates very, very aggressively. And that leads us to what we know as the tech years, 1996 through 2000 or so. Going back to present day, now knowing everything we know, the white line again is inflation, the red line's jobs. We went from nearly 0% interest rates following the COVID crisis, 2% inflation target, inflation through the roof. And inflation has started to subside, but we're still above the 2% target. The jobs number slowing down. Remember, we said the jobs seem to kind of decline before inflation does. Well, this gap is actually decreasing. Inflation is coming down. Moving forward, what can we take away from this? Is that we need to watch to see that the jobs numbers don't really fall apart. I think the jobs, and I don't know that it's fair only to talk about jobs in this generic, format. What does the average salary buy these days compared to the 1980s? That's a different discussion. But nevertheless, that's where we are now. We want this white line, this inflation number near the 2% targets, and we want the jobs number, the red line, not to go down too much. And then we'll see an end to interest rate hikes. Here's an interesting way to look at it, though. The black histogram bars, that's the Federal Reserve interest rates. White line represents inflation minus Fed funds. So we have inflation right now at, let's say, 3%, and we have the federal funds at the 5.25%, 5.5%. So we're actually negative 3% minus 5 is negative 2. That's where we are right now. The red line is just a 100-period moving average. It's a 100-month moving average, just to smooth things out. Notice two things. First of all, notice the upward slope. That over time, and what is this showing us? That the Federal Reserve has to combat higher inflation over time from 1982 through present day. That we see that inflation compared to interest rates is up more and more and more. You can blame fiscal spending, you can blame a lot of other things, but the fact of the matter is inflation, relatively speaking, compared to Federal Reserve interest rates is higher and higher and higher over time. And the other thing is that we can use this moving average as somewhat of a target, where we say, okay, we should see inflation 1% above interest rates. Interest rates right now are at, 5.5%, 5.25%, 5.5%, and inflation's at 3%. Ideally, we should see inflation at 2% and the Fed funds rate at 1%. That's, if this math holds true. But the fact of the matter is we can see over time that in 1980, the early 1980s, we had very, very high interest rates, and then the inflation minus interest rates was very, very low. Then we had that recession 1990, and then we all of a sudden we had a lot of inflation come back into the economy, and then really rose to rear its ugly head in the 2000s. And then we had the financial crisis, and then we had inflation was down below interest rates. They raised interest rates. We see here the black line represents interest rates. So again, when the black histogram bars go up, it sends this white line down. High inflation, they raise interest rates, it brings the white line down. Low interest rates, the white line creeps up. The white line going up shows inflation's out of control again. They raised interest rates a couple of years ago. That brought us back down. That was the softest landing I think we've seen of everything we've looked at. Now we had this enormous spike in inflation that we know now, that now we're dealing with. And we had a massive decrease in inflation. But we want to see this lower. We want to see it back mid 2000s in that level. So that shows us we still have some work to do. But I think it's very interesting to take a historical look at the Federal Reserve, their role in using interest rates to control inflation while very carefully not hurting the jobs market. And I think it's very timely since we just had this Jackson Hole summit. And we're going to continue to watch the economic calendar because it gives us a day-to-day little reading on the economy and insight into the Federal Reserve and what they may do next. We hope this has been helpful. We look forward to seeing you back soon.